Welcome back, everybody. This is Money Mondays with your hosts, Ben Suttles and the infamous
Ferris
Musa from Disrupt Equity. And we are doing this every Monday at 3:30-ish.
Central. So we are running a little bit late today. The powder took a little bit longer to apply to Ben and my face. Don't worry, I took the blame too. But we are here. So fortunately, we don't have powder, but it probably would make us be just a little bit more charming.
Just a little bit, tad bit. Well, all right. So since we are running late, folks, we're going to get right into this. So what are we talking about today, man?
We are talking about the market update, the thing everybody wants to know. You know, for us, we do a ton of underwriting, a ton of offers. I've already talked to 3 brokers today, and I didn't even have time to talk to a broker. So that gives you an idea of the. Yeah, really, I have talked 3, maybe 4 actually. Different brokers today. That gives you an idea of at least how much of a pulse we have as a company in tune with what's going on in the market.
Multiple
markets. I mean, 2, 3 different markets for those brokers. So definitely very interesting, and it's, we're in uncertain times, right? It's definitely very different than it might have bhan 6 months ago. So
I'd even say 6 weeks ago, really.
Yeah, I mean, that's very true.
Things have really changed, folks, and I think, obviously everybody's hearing what's in the, the news. Interest rates are going up, and inflation, all these things. But I think ultimately, what does that mean for you as a buyer of multifamily or just a buyer of real estate, really, right? So let's get right into this. Again, we are probably in a good position to be able to opine on this. We look at, 20, 30, 40 deals a week sometimes?
Yep.
We were on a seller interview today, so we're getting into best and final every week too. So we have a good pulse on where things are trading, and as Ferris mentioned, a good pulse on what the brokers are saying too. So getting right into this, we got some crazy questions coming in here.
So let's talk about it, right? So we're going to talk about 3 things: cap rates, hot markets, and pricing.
Yes.
They kind of go hand in hand. So cap rates, what are we seeing, Ben?
I really haven't seen cap rates expand as much as I think people are expecting.
And even on deals where we get told, hey, guidance has now changed significantly.
Yeah.
It looks like it's still popping at the very finish line like we saw today.
Yeah. So we had a deal that we felt like was a pretty good basis for what it was.
Yeah, I mean, the guidance dropped quite a bit, and then lo and behold.
And then ramped back up.
Ramped back up to guidance. And so we are seeing, I would say guidance across the board has been dropping 5 to 10%.
Yeah.
Right, brokers are starting to make calls, starting to go to their closers, the people they know will still get it across the finish line.
Yeah.
Thankfully, we're on that short list, right? And there's whispers, right? That's maybe what I'll leave it at that. There's rumblings, whispers going on, brokers fishing around to see who's looking for what, and people trying to get deals done. And I think part of that too is because there's whispers. You now have some sellers who were thinking of, hey, I'm going to wait and ride the market longer. Now they're waking up and they're like, hey, maybe I'm gonna make an exit right now and just lock in my wins.
Yeah, because you just never know where the future will hold, right? If we had that crystal ball, we'd all be a lot more rich, right? So at the end of the day, folks, what we're seeing is instead of those 30 tours and those 20 offers, right, you're probably splitting that in half, right? You're probably having 15 tours and maybe 5 to 7 offers, right? So that is forcing some of the brokers who, let's be honest, for the last year and a half, 2 years have been riding the market quite aggressively and really haven't been soliciting a whole lot of offers just because things were going to fall into place and they were going to get at or above guidance, are now calling people back. They're saying, hey, you guys should throw your hat in the ring, even if you're $1 million, $2 million, $3 million less. In this case, whispers were, significantly higher than where we came in, and we still got into best and final, and we were probably number 2 on that deal. Now, as Ferris had mentioned, it ramped back up, but it still traded for less than what the initial guidance was.
Yeah, it still is. And, and again, we're seeing that nets, I'd say A, B, and C.
Yeah.
And actually, I'd almost say more so B and C. Would you agree with that?
Yeah, I'd say that.
The A is still...
And A's always really are going to be a lower cap rate anyway, right? You're either going to have buyers in the market or not, but pricing is typically not going to be drastically changed. Where I've seen is that at the end of the day, the B and C stuff has ran up so much just because everybody's chasing some value add deal that, at the end of the day, those are going to be the first ones that are going to come down a little bit faster too, right? Whereas the A-class assets, people kind of know what they're sitting on. Some of those are really sexy. Sometimes they're going to be in sexy locations. There's always going to be a buyer for those for the most part, right? So to answer the question, cap rates, I really haven't seen them expand. They've expanded a little bit, right? Obviously that the expansion in cap rates is going to decrease the price. That's how this works, right? They're inverse of each other, right? I'd say it's still hot.
It's
right?
still a hot market.
There's still people because
slowing down, but still hot.
I'm going to tell people the reason why it's still hot, right? There is a ton of money in the market, and they're looking for good places to put money
Just
into.
so happens real estate is a good hedge against inflation.
Real estate is a good hedge, and multifamily even in conjunction to just being in real estate, right? Multifamily is great because obviously everybody needs housing, and it's a tried and true asset class that has really weathered the storm over the last 10 or 12 years. And let's be honest, folks, we have two things that are going against us. Right, in this country, not necessarily multifamily, right? You got a housing shortage, right? So home builders just aren't building enough, right? And then in these hot markets, on top of that, to add, injury, insult to injury, right? You're also going to have a lot of population growth. So there's just not a lot of places for these people to live.
Yeah, and then
right?
I also would add the other thing that people haven't been talking about is the millennials that were basically staying at their parents' homes are finally kind of leaving the nest.
Yeah,
maybe they did a little bit later in the previous generation, but they are, and so that's turning into an influx of people looking for their own place to stay.
That's true. That's true. Right. So, but you got in the Sun Belt, you got a tremendous amount of population growth. Home builders are slowing down. Obviously, price of materials is driving some of that.
And that's the other big thing too, right? Pricing materials has gone up. Yeah. Prices have gone up, and now, right, where it's interesting is now with interest rates going up. Right, it's going to be interesting to see what happens in the housing market. Yeah. And honestly, my theory is it's actually a boom for multifamily. Because now the person that was going to go buy a house because the rates are lower, well, guess what? Rates went up. The cost of having a house is actually going up, right? Your mortgage that might have been $1,500 is now $1,700, right? Yeah. And so therefore, an apartment makes more sense. And so that's ultimately, I think, why we think cap rates are just plateaued. I'd
also say that probably hurts single-family rentals a little bit too, right? Because to cover that note, they're going to have to charge more in rent, right?
Correct, for a new you're buying new investor of a house.
Yeah, you're buying a house, you're putting mortgage on it, right? Now your notes
are. I have 2 rentals left.
They're locked in, right? They're locked.
2 left. Yeah, they're locked.
So they're locked.
Your point stands.
So people getting into the market, that's a good point. Versus obviously, so that's why everybody should have refinanced last year. But point being is that there's still a lot of, I guess I'd say there's still a lot of demand, and the supply is just not there. So I think that's why people are not seeing a bigger dip in this premium pricing, is just because you've got those two kind of imbalances, and then on top of that you just got a lot of money. And the other thing that's different from 8, 9, and 10, because I'm not saying that we're going into a recession, nobody's saying that, right? But the lenders are still lending too. Yeah. Right, so they still have capital to lend. They might have been coming off of their leverage points a little bit. The spreads, which is again, folks, remember you've got an index that your rate is based off of. Let's just call it the 10-year. Then you've got a spread on top of that, right? So that spread, if it gets wider, the lender's trying to make more money on you. If it gets tighter, they're making less, right? And then they obviously base it on whatever index is happening, whether it's SOFR, LIBOR, or the 10-year. That's kind of typically where this is how this works, right? So spreads are expanding a little bit, leverage is coming down. You're typically not going to see an 80% LTC deal anymore, right? You might be able to still get those on a really smoking hot deal, but I would say the highest that you're probably going to get right now is 75%. I would go ahead and start penciling in at 70. Right, but the hot markets, right, are the same ones that they've always been hot. And the reason that we were talking about earlier, right, you've got a ton of population growth coming to the Sun Belt. That's not stopping, people. And that population growth is driven by jobs and tax-friendly places to live and business-friendly places to live. So, again, those things are fundamentally they're not gonna change anytime soon, if at all. And that's the reason why people are fleeing the coast or fleeing up north, right? And I'm not trying to say anything to our friends that live in those spots. There's advantages there too. But as far as multifamily goes, that's why everybody's chasing deals in the Sun Belt. Let's be honest, right? And I don't think that's going away.
And then maybe with the Sun Belt, you have all the retirees looking for somewhere nice and warm to stay.
That's true. So that's the people that you move from the north. My parents moved from Ohio. They said they would never move back to Ohio because the winter's tough.
Because they're looking for the sun in the belt. So that's why it's the Sun Belt.
So. All right. So we're moving along here. So we talked about competition. Again, it's probably split in half right now. I think there's a lot of price discovery that's happening right now, and that's the reason why people are kind of on the sidelines. I don't think anybody's tremendously spooked. I think everybody's kind of trying to figure out what the Fed's going to do. And like us, we've got some deals that are teed up. We'll talk about that at the end here. But, we're going to get those across the finish line and then see what happens with the market, right? Because you just never know, right? And if they really want to get aggressive and spike it quite a bit, yeah, they're going to stall out the economy. In fact, they're probably going to crater the economy. So the Fed is playing a little bit between a rock and a hard place, unfortunately. And I don't know. I'm not quite sure if I'm sold on how much they're going to raise rates.
Yeah,
man.
I'm actually curious too. Part of me is itching for them to say, because now you saw, what did you see last week? We saw the stock market fall quite a bit.
Well, that and the GDP contracted too, right? It was negative 1.4 when I think they had initially thought it was going to be one, right? So there's a pretty big swing there.
And so part of me is itching to see the Fed say, hey, we're going to slow down the interest rates. Yeah. And what does that mean? Bull run for apartments.
Well, and the other thing too is, so we're talking about, the GDP, right? That was Q1, right? Or was that Q2? I think it was Q1.
That would have been Q1.
Yeah, I think that was Q1. So you start looking at Q2 numbers, because we're in the middle of Q2. I haven't had my coffee, as people can see, right? And that's when all this bad stuff's been happening, right? Russia, Ukraine, the inflation really went through the roof. I would say you're probably going to have it contract again, right? And 2 quarters in a row typically means that you're in a recession.
I think they've already officially said we are in a slight recession. I think I saw that last week.
So, the Fed takes that into consideration, right? Lenders take that into consideration, and that's why they're backing off of leverage points. They're expanding their spreads, but they're still lending, right? Again, that's different from 8, 9, and 10 when we had the Great Recession, when lending essentially locked up and people were having to pay all cash for certain things, right? So interest rates expanding, financing is still available, but getting a little bit tighter, right? Competition, I would say it's been a little bit easier to get deals across the finish line. And like Ferris said, the brokers are going back to people that are closers. They're not gonna bet on a lot of the newcomers, unfortunately. And I'm not trying to be mean to the people that are starting off, right? But right now they know that things are a little shaky, and they're gonna take maybe a little bit less of a price, or allow you to preempt a deal and give it to somebody that they know is going to be able to weather the turbulence that's going to be going on in the interest rate and the lending environment, right? That's just how it is, right? So competition is probably going to get a little bit less, which is good for some folks. And again, I think the other thing that's good is you've seen some people come off of pricing, right? So, what does that do with investor interest? I think we're still seeing a ton of investor interest, right? I mean, we just recently rolled out our Sunbelt portfolio fund, which if you're on our list, check that out. We're going to be officially launching that tomorrow, but we got a ton of interest. And I think, again, the fundamentals haven't changed, right? You've got a lack of supply, a ton of demand, population growth, job growth. All of the things haven't changed in these locations that we're buying in, right? In fact, they're getting probably better in some respects.
And again, inflation, right, means better rents, which means even people that do buy deals today, their hope is obviously rents go up. Their cap rates and their kind of return gets better over time. So.
Yeah, absolutely. So I'd say that investor interest is still there. You're always going to have the people that are going to wait on the sidelines, or the doomsayers, and the people that think that the sky is falling. And I get all that, right? You always need to mitigate your risk. You need to be cautious right now. But at the end of the day, there's always opportunities in every part of the cycle, and we're buyers, right? So we're seeing a ton of investor interest, right? So that's what we're seeing right now. We'll continue to do this. Maybe we'll have another one in Q3 just to kind of see if any of our, our thumb of the air, projections or predictions, have come to light. But I'm going to go ahead and pause here.
Yeah.
Do
So
a little
if
bit of open Q&A.
Questions, comments, thoughts, please go ahead and leave it. We will answer them live. But let's see. We did get one, which is kind of off topic, but I'll answer it. So August says, how about the Seattle event? Love to hear more about it, as based in Vancouver, BC. So for those of you that don't know, we have a big conference that we do. Our goal is to do 3 a year. The last one we did was here in Houston in our backyard. 600 people, 200 people on the wait list. Awesome time. Yep. We're doing the next one coming up July 23rd in Seattle. So if you're interested, check out mfinvestornetwork.com. Coupon code DISRUPT. And for us, we don't make any money on it. We don't sell it. Our goal is just to break even. Yeah. But it's about putting together a high quality event, high quality group of people, and help get people educated, right? I mean, for us, we like to say that the best investor is an educated investor.
Yes.
And this is our way to help create more awareness, expose people to multifamily, and from there, let them make their own informed decisions.
Yeah, absolutely, right. And we're putting people into a situation where they can do some networking too, folks, right? It's a numbers game, but it's also a relationship game. So, you're not going to learn everything that you want to learn about multifamily on a one-day event, folks, right? Yeah. But you might have one or two great relationships that you walk away from. And we've met a lot of great people through this too. Oh, yeah. And that's really one of the reasons why we put it on, right? Just to kind of be able to meet and mingle with other people that are doing deals or people that want to do deals, right? So check that out. Seattle, July 23rd. Awesome. And put in that coupon code DISRUPT for $100 off on that.
So let's keep going.
Yep.
Buddy Ronnie says, what's going on, Ronnie? Thoughts on volume of transactions of B and C class deals in Houston? I'd say, I guess so. Over the past year,
there's been a lot.
Houston has become a lot more interesting to most people, right? Yeah. It was kind of a sleeper, and us included. We did not actively buy in Houston until more recently. Houston is, it's got a lot of bullish indicators, coming up, and so we like Houston. We see the growth story, and now rents have been very, very affordable for the longest time. And you're seeing a lot more deals trade. And so you see a lot of people, because what happened in Houston, for those who don't know, you had 2016, prices were sky high. 2017, 18, oil crashed, right, and prices fell significantly. And so a lot of those people, literally, we see these deals, and the pitch is, get it back to 2016 rents. That was the pitch for the longest time. Well, we're well past that, but a lot of those people that got stuck in those deals are now cycling out.
Yes.
You see new buyers coming in the market, those deals transacting, and everybody essentially pushing rents. And so we like the Houston story. We're continuing to buy in Houston. And Ronnie was talking about B and C class deals.
I'd point something out too.
I'd say we saw a lot of A transactions in Houston that we did not see historically.
Well, let me mention this too, folks. What you don't know about Houston is that there's a moratorium, essentially self-imposed moratorium on building apartments from, call it 1985 to 1995. You have very little product. And one of the biggest cities in the country, you have very, very little product that was built in a whole entire decade, right? So you have a lot of stuff that was older than that, and then you have a lot of newer stuff, right? And so that kind of limits the amount of supply that you have in this market, right? And so that's typically why you're going to see a lot more Class A stuff trade in Houston, because there's just not a whole lot of Bs. There just really isn't a whole lot that was built in 1980s in general, right? And so I would say that, up, and we still see a lot, but I'd say up until probably the last, month or two, there's been a tremendous amount of trading that's happened in Houston. And it's cutthroat. There's been people chopping each other's legs off to get this stuff. And, rightly so. Again, like Ferris had mentioned, now you're starting to see rent growth. Population growth's always been there. The one thing that I always tell people about Houston is last decade, it was number 2 in terms of population growth in the whole entire country behind DFW. And same thing for this decade. DFW, then Houston. Right? There's a reason why people are flocking to these two locations, right? They're great places to live. It's tax friendly, it's business friendly. There's a ton of jobs. There's a ton of just opportunities in these markets. And so, why wouldn't people move to Texas, right? So, and that is not going to change as it hasn't changed. So, and if you also want to say, hey, you've also got a supply constriction problem because they didn't build anything for 10 years, you're going to have some rent growth, right? So that's why we've been looking at it over the last 12 or, probably 18 months and bought up a few deals, and we'll continue to buy in Houston until, again, we see some kind of an imbalance that will kind of push us to another market, right? Because we're opportunistic. You can't be, I only want to buy in my backyard. That only works so long, right? And then you're either gonna get priced out or you're gonna miss out on opportunities. You need to be able to expand beyond your backyard and buy in different states and different cities. So, but great question, Ronnie, and I hope you're doing well, buddy.
Let's keep going. So let's see. Amanda says, what do you see happening with investor returns? Are you adjusting expectations for cash flow, total returns, or hold period? Absolutely. We have adjusted returns, over the past couple of years, right? Yeah. And for those that know us, we try to present what we actually hit, right? We have a joke where some deals you see where it doesn't matter if the person's doing A class, B class, C class. If it was 2 years ago or 1 year ago, they're always 16, 17, 18% IRR. Yeah. For us, our targets have changed, right? We are presenting numbers that we think we could hit. And so what we would have, on the same deal to give numbers, if what we would have said was 17 IRR is now probably a 14 IRR. Yeah. Right. And so that has shifted, and we've been adjusting our investor expectations, right? And again, as you buy newer assets as well, right, the expectations need to drop. And so I like to say I can buy any deal in the world as long as my investors are okay with those returns. Yeah. And so if I have investors that are okay with a 3% return, guess what? I can go buy the high rise and the medical center or whatever, deal you want to buy anywhere. So
some of those deals are a little bit better than 3%.
But point noted, right? So And then a hold period, I would say
It's always been 5 to 7
Yeah,
years.
yeah,
I don't think that's changed that
that's
much.
less return driven, and that's more emotional driven, I'd say. Right? People aren't comfortable parting with their money for that long.
Yeah, I'd
So,
say you
regardless
put
of the return
You
profile.
put 10 years out, you're gonna discourage some people from investing in your deal, and then on the flip side of that, if you put it too short, people are gonna say, are you gonna really be able to execute on the business plan? And is that gonna give you enough time in case we do have a slowdown in the market to be able to execute said business plan and get out of the deal, right? So we've always found that 5 to 7 years is a good kind of
So
sweet
I'd say
spot.
we've adjusted the return profile. We've not adjusted the time frame.
Yeah.
I did catch up with one of our friends this weekend that does the really long-term return, so I got to tell Ben about that.
Oh, okay. Well, no. And we're also doing something a little bit different in terms of the returns, too. We're doing, the next few deals that we are going to be under contract on is going to be part of a fund, right? So it's blended all together.
Portfolio.
Portfolio, excuse me. It's called a portfolio. And, at the end of the day, right, that's all blended together, and people like that because it's a diversification play, right? So you're in multiple markets. You get a little high appreciation, you get a little bit better cash flow just depending on the market. It all kind of balances itself out, right? But typically, just to give everybody some perspective, right, you're at 13 to 16% IRR, and this is based on us looking at 20, 30 deals a week, folks. Realistically, things are at 13 to 16%, on the best side of things. Right now, you can drop your reversion cap rate and you can try to shoot your IRR up, right? But we don't do that. We think we're conservative on the back end. And then cash on cash is anywhere from 6 to 8. I've sometimes seen it closer to 9, but most of the time it's going to be 6 to 8 right now. That's just where things are at, right? But again, you get a diversification play, you get the tax benefits, you get ultimately a safe place to put your capital, right? That's a hedge against inflation. So multifamily still has a lot of things great going for it, and you've got rent growth that has been tremendous, and that's not even just in Houston. Everywhere has been on fire in terms of lease trade outs. I mean, like $200, $300, $400, folks. We look at Florida, and the lease trade outs there are just insane.
Yes.
So
let's keep going. So August asked another, I guess, a good question. Let's talk about financing. Is bridge risky in the current increasing interest rate environment? The answer is yes, depending on how you do it, right? And so, we're doing deals with bridge, and it sounds like everybody, and I'll update Ben on that later, right? But there's ways to mitigate risk. So the problem with the bridge is you got to do the bridge going in, and you got to do the refi in the back end, right? Guess what? If you have more cash, you can help ensure you do that refi. More cash means lower return, so again, make sure you kind of model it out and you hit the right expectations. Yeah. But there's one way to mitigate risk. The other thing too is interest rate caps.
Yeah.
Right. Typically, historically, we've bought that down. What a cap is basically mitigating your upside risk, and so you're buying insurance to basically say, hey, my ceiling is a certain amount.
Ceiling on the interest rate, right?
Ceiling on the interest rate.
So your interest rates, if it spikes, the cap kicks in and pays it off. It's
now interest rate caps have gone up in pricing quite a bit over the past 6 months. So again, know that, plan for that, right? This is where you can raise a little bit more money to buy down that cap to reduce your risk on the upside, right? And typically those caps are going in for 3 years, so just know that it doesn't solve your 4 or 5 problem, right? Yeah. But again, it's about going into the right deals and model it out and make sure that there's some meat on the bone. I would not go into an A-class bougie deal that you're not going to do any sort of value add on the bridge. It's hard, right?
I would say that too.
As long as you have a way, whether it's doing interior upgrades or you're doing loss of lease to burn off, right? Ways to get that NOI higher, so that way year 3 you can get out of the loan and go to something else. And so we've looked at A, B, and C, and again, there's ways to make them work. But just know it going in and plan accordingly.
Yeah, for sure. And I'd say a couple other things too, right? So you got a 3-year initial term. Now you could have a bridge loan, 2 years, 18 months, whatever. I'd say get your 3-year initial term and make sure that you're negotiating those 2 1-year extensions. So for folks that, that's one way to mitigate it, right? That's 5 potential years that you have this essentially locked up, right? He talked about interest rate caps. There's other things in financing too. I'd ask you to reach out to Anton Matley with Peak Financing. He can go through a lot of these scenarios a lot better than I can, but there's also fixed rate options outside of Fannie and Freddie. A lot of people didn't realize that, but there's other banks and other lenders that will do fixed rates, right? But instead of it being, call it 3.75, it's probably 5.5, but it's fixed. Right? And sometimes you can get 5, 7, 10-year terms, right? Now, there could be a recourse component. There could be something else that you have to take into consideration, right? But at the end of the day, there's other lenders and other banks out there that will lend fixed rate deals too. So if that fluctuating interest rates, floating debt is a little bit scary, and don't get me wrong, right? We try to mitigate that risk too. you can look into those fixed rate options. There's also things that you could do like swaps and some other stuff too. So I encourage you guys to reach out to the experts and ask about those options, because there is stuff out there, and that's how people are still getting deals done. And let's be honest, the recession, if we're actually truly in one, it will probably be another, call it a quarter or two. And then they're going to do things that are going to obviously juice the economy again. It's a vicious cycle. I hate to say it. That's just kind of where we're at, right? But they're not going to let people languish in a recession for too long, because obviously you've got midterms coming up and you've got other things that politicians take into consideration. They don't want to be, in office that cratered the economy. So,
all right, let's keep going.
All right, no politics, no politics. Sorry.
So that's all we got. So keep going. Next section.
Let's do it. So this Thursday, oh my gosh, I can't believe it's already here.
Yep.
Right? What are we doing?
Doing our meetup this Thursday. We're talking about getting rich from real estate in today's market. We're doing a panel with some of our friends, and so if you're around, you're in Houston, you're in Texas, you're in anywhere you feel like driving in, come check it out.
Wow, we got Jonathan out there, we got Muriel, we got Cody Laughlin, we got Chris Bounds, all great folks, all doing deals. Right, so they're going to give you a lot of perspective, and doing different types of deals too, right? So check that out. That's Pitch 25 this Thursday, 7 p.m. Central Standard. So if you're in Houston, check it out.
Where can you book tickets?
Where do you book tickets? DisruptEquity.com/HTX meetup. You threw me for a loop there, buddy. But check that out. Register. There'll probably be about a good 150 people there, right? We typically get a good turnout for that. So come out, check it out, learn a few things, exchange some business cards, get out there and network, folks. It's important, right? We talked about MFIN. Go ahead and check that out. mfinvestornetwork.com. Put in that coupon code DISRUPT. Get your $100 off. We're not making any money, but we will see you in Seattle on July 23rd. Boom. We got through it. But last but not least, Sunbelt Diversified Portfolio that we are launching tomorrow. So check that out. If you're not on our investor list, go ahead and register. You want to at least know what we're working on, see how we position things, ask questions. It's disruptequity.com/invest. Get on our list. This is a 506C for all of the people that want to say you can't be soliciting. Well, guess what? We're doing a 506C. So I am going to solicit a little bit, but we're getting those 13 to 18% average annualized returns.
We talked about
7 to 9% cash on cash across Austin, which we're really, really excited about, Daytona, and one of our favorite backyards, Atlanta, Georgia. So check that out. We'll be sending that out tomorrow. So what are we talking about? Oh my gosh, I am still raising money for a great cause, Veterans Community Project, bit.ly/donate to Homes for the Brave. Raising up to $30,000. Would love any amount that you could actually, give, even if it's $5 or $10. This is a great cause. We're building tiny homes for homeless veterans. Doing that with my friend Eric Dupchurch, and I'm matching dollar for dollar, everything up to $15K, folks. So let's see if we can make this happen and try to change the tide on this whole pandemic that we have going on with homeless veterans, right? Great cause. Check them out, Veterans Community Project. What is coming up next week,
How to build your exit strategy in multifamily real estate.
Oh,
we've done a few exits in our career, and so we can kind of talk about what you need to know, how to think about it, and what you need to plan for.
Love it, love it. So we will see you next week.
3:30 Central every Monday. Thank you all very much.